There's a guy sitting on $2 million in retirement accounts who just told his wife they need to work 3 more years because healthcare costs $15,000 annually. That's 72 months of alarm clocks and meetings and commutes to avoid spending $45,000 total when he's literally a millionaire twice over. Meanwhile, there's another couple, same age, same net worth, retiring next month and planning to spend maybe $3,000 a year on healthcare until Medicare kicks in at 65. Same insurance, same coverage. What's the difference? The second couple understands something about the tax code that the first couple doesn't. And it's going to cost the first couple roughly 8,000 hours of their life they'll never get back. So here's my question. How many people are working jobs they hate because they think healthcare makes early retirement impossible, when the real problem is they saved their money in the wrong pile? I'm going to explain exactly how healthcare costs in early retirement actually work, why the recent subsidy changes everyone's panicking about matter less than you think if you plan correctly, and the single biggest mistake I see people make that turns manageable healthcare costs into a retirement delaying nightmare. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Here's the central idea you need to understand. Think of your income in retirement like a theater production. There's what's actually happening backstage, which is your real wealth and spending power, and there's what the audience sees, which in this case is the IRS and the Affordable Care Act marketplace. You're the director. You decide what goes on stage. Most people don't realize they're directing this show. They just dump everything into their 401k for 30 years, then act surprised when they can't control what their income looks like on paper in retirement. That's the game. You have millions in the bank, but on your tax return, you can look broke. And looking broke, legally and strategically, is how you pay $2,000 a year for health insurance instead of $20,000. Let me show you the math on this, because this is where it gets wild. The Affordable Care Act subsidies, the ones that help you pay for health insurance before you hit Medicare at 65, they're based on something called Modified Adjusted Gross Income, your MAGI. Not your net worth, not your account balances, your income as it appears on your tax return. So if you're a married couple and your MAGI is under about $82,000, you're getting subsidies. If you're just over that, especially with the enhanced subsidies expiring, you're potentially paying full freight. Now here's what's hilarious and tragic at the same time. You could have $5 million in a brokerage account, pull out $100,000 to live on, and your MAGI might only show $20,000 of taxable income. How? Because most of that $100,000 is your original principal coming back to you. You bought stocks years ago, they went up. When you sell, only the gain is taxable. If you bought something for $80,000 and it's now worth $100,000, you're only paying tax on the $20,000 gain. The other $80,000 just moves from your brokerage account to your checking account, invisible to the income calculation. But here's the problem most people face. They did everything right according to traditional advice. They maxed out their 401k every single year, got the employer match, watched that account compound into something beautiful. Let's say they're sitting on $1.4 million in their 401k and IRA accounts, maybe $60,000 in a Roth and $70,000 in a taxable brokerage account. They're objectively wealthy, millionaires. And they're completely screwed on healthcare costs because every single dollar they pull from that 401k to live on is 100% ordinary income. All of it shows up on the tax return. They need $80,000 a year to live. That's $80,000 in MAGI. They just priced themselves out of subsidies entirely. They're staring at healthcare premiums of $18,000 to $25,000 a year for a couple until 65. They're what I call qualified rich and cash poor. Rich in accounts that create taxable income, poor in accounts that don't. The subsidy cliff everyone's worried about right now, it's real. The enhanced premium tax credits that were extended during COVID, they're expiring. For a couple earning just over 400% of the federal poverty line, we're talking about $81,760. You could see your annual healthcare costs jump by $3,800 or more depending on where you live. Insurers are proposing median premium increases of 15% for 2026. Out-of-pocket maximums are rising to $21,000 for families. Individual caps around $10,000. These are not small numbers. But here's what I need you to understand. These changes are only devastating if you have no control over your income picture. If all your money is in pre-tax retirement accounts, you're a passenger. The tax code is driving. You pull money out, it's income. End of story. But if you planned ahead, if you have a taxable brokerage account with substantial assets, you're the one driving. You control the income dial. Let me give you a real scenario because I want you to see this in actual dollars. I'm looking at a couple, 55 and 54 years old. They have about $225,000 in cash savings, which is honestly too high, but that's a different conversation. They have $1.4 million in investable assets split between 401ks, IRAs, a Roth, and a brokerage account. They own their home outright. They were planning to retire at 62. That gives them 3 years until Medicare. Then all this healthcare fear started hitting the news cycle, and they called me asking if they need to push it back to 65. Let's run their numbers, assuming the absolute worst case scenario on healthcare. They're gonna budget $15,000 per year per person, $30,000 total annually. That's not the average. That's worst case, full premium, minimal subsidy territory. They also wanna spend $50,000 a year on travel because that's their dream retirement. So we're looking at $80,000 in annual spending plus $30,000 in healthcare, $110,000 a year. They retire at 62. What happens? If they have a balanced portfolio, let's call it 60% equities and 40% bonds, pretty standard risk-adjusted allocation for someone in their 60s, and we assume average market returns, nothing spectacular, this couple still has over $1.5 million at the end of the plan. They don't run out of money until they're nearly 90, even with worst-case healthcare costs. Now let's say they get smarter about it. Let's say 5 years before retirement, they stop maxing their 401k beyond the employer match, which is free money, so you always take that, and they redirect everything else into their brokerage account. By the time they hit 62, instead of having $60,000 in a brokerage account, they have $300,000. Now watch what happens. They can pull $80,000 annually from that brokerage account to live on. Maybe $65,000 of that is principal, only $15,000 is capital gains. Their MAGI is now $15,000. They're suddenly eligible for massive subsidies. Their healthcare costs drop from $30,000 a year to maybe $4,000 a year. Maybe $6,000 if they want a gold plan instead of silver. That's a $24,000 annual swing. Over 3 years until Medicare, that's $72,000. That's a new car. That's a year of travel. That's real money that they keep instead of handing to an insurance company because they understood which pile to save in. Now, you might be thinking, okay, but what if I'm already 55 and everything's in my 401k? Am I just out of luck? Not entirely. You have options. They're not as clean, but they exist. Option 1, you work 3 more years. Not because you want to, but because you're doing the math and you're making a strategic choice. Those 3 extra years do 2 things. 1, you're building up your taxable account. 2, you're delaying when you need to tap the retirement accounts, which means more compounding and a larger total asset base to work with. Option 2, you plan to do Roth conversions strategically in early retirement. You're going to pay tax to move money from your traditional IRA into your Roth IRA, but you time it in years when you can afford the tax hit without spiking your MAGI so high that you lose all subsidies. It's a tightrope walk. You're converting just enough to fill up the lower tax brackets, but not so much that you destroy your healthcare subsidy for that year. Option 3, and this is the aggressive play, you shift your asset allocation more toward growth. You take on more risk in exchange for potentially higher returns that offset the higher healthcare costs. Maybe instead of 60-40 stocks to bonds, you go 70-30 or even 80-20. You're essentially saying, I'm willing to accept more volatility in my portfolio value if it means I can retire earlier despite expensive healthcare. That only works if you have the stomach for it and the time horizon to recover from a bad sequence of returns. Here's where this gets really interesting. I pulled up data from KFF, the Kaiser Family Foundation, which is basically the definitive source on healthcare policy analysis. They publish projections on how much ACA premium payments rise with a subsidy expiration. For a 60-year-old couple making $82,000 a year, we're talking about significant increases. But notice the framing. It's making $82,000 a year. That's income. That's the number on the tax return. It's not a couple with $800,000 in assets or a couple with $1 million net worth. The system doesn't care about your wealth. It cares about your income. And if you have control over how you generate that income, you have control over your healthcare costs. The entire panic around subsidies expiring assumes you're a W-2 wage earner or you're pulling everything from taxable retirement accounts. If you're neither, the expiration matters way less. I want to show you exactly how bad the qualified rich cash poor trap is, because I don't think people really viscerally understand this. Let's say you're 58 years old. You have 1.2 million in your 401k. You have 18,000 in a brokerage account because you barely ever funded it. Everything went to the retirement account because that's what every financial advisor and personal finance article told you to do. You need 70,000 a year to live on. You retire year one, you pull 70,000 from the 401k. That's 70,000 in Magi. You're paying close to 20,000 a year for healthcare for you and your spouse. No subsidies. You're above the threshold. Over 7 years until you're both on Medicare, you're paying $140,000 in healthcare premiums. Now imagine alternate universe you. Same age, same net worth, but you have 600,000 in the 401k and 600,000 in the brokerage account. You pull 70,000 from the brokerage. Let's say 45,000 is principal, 25,000 is gains. Your Magi is 25,000. You're deep in subsidy territory. You're paying maybe 5,000 a year for healthcare. Over 7 years, that's 35,000. You just saved $105,000. Same net worth, same retirement lifestyle, different pile. This is the part where someone always says, yeah, but I'd have to pay taxes on that money eventually anyway when I pull from the 401k. So what's the difference? Here's the difference: timing and control. When you're 73 years old, the IRS forces you to start taking required minimum distributions from your traditional retirement accounts. You don't get to choose the timing. You don't get to choose the amount beyond the minimum. You're on their schedule. If you have too much in there, your RMDs can spike your income so high that you're paying more in Medicare premiums because of IRMA surcharges, which is this delightful thing where if your income is too high, Medicare charges you extra. You could also bump yourself into higher tax brackets. You lose control of your tax situation for the rest of your life. Versus if you'd done Roth conversions or funded a brokerage account earlier, you have optionality. You can choose which account to pull from in any given year based on your tax situation that year. That's worth a lot. Here's a quick bit of cynical comedy for you. I was looking at one of those big financial planning software tools that advisors use. It has a healthcare cost estimator built in. You plug in your age and retirement date, and it spits out an estimated annual healthcare cost. It defaults to the national average, around $6,400 per year per person. So for a couple, about $12,800 annually. Which sounds almost reasonable until you realize that average includes people with massive subsidies paying almost nothing and people with zero subsidies paying $30,000. An average of those two things is meaningless for your personal planning. It's like saying the average net worth of a room with you and Jeff Bezos in it is $50 billion. Technically true. Completely useless for deciding if you can afford lunch. But people plug these numbers into their retirement calculator, see that they're fine, then get absolutely destroyed by reality when their actual premium is triple what the software said, because they're pulling all their income from the wrong account type. The software was right about the average. You're just not average. Let me give you another scenario, because I want to hammer this home. You've got a couple who saved incredibly well. They have 2.5 million across all accounts. They're 56 and 55. They're looking at a retirement spending plan of 90,000 a year, including healthcare. They want to retire at 60. That's 5 years until Medicare. Let's say their asset mix is 1.9 million in retirement accounts and 600,000 in brokerage and cash. They run the plan. It works. They have money left over at the end. Great. But watch what happens when we model their healthcare costs accurately. If they're pulling most of their income from the retirement accounts, because that's where most of the money is, they're looking at 20 to 25,000 a year in premiums. But if they intentionally draw down the brokerage account first, spending it over those 5 years before Medicare, their Magi stays suppressed, They get subsidies, and they're paying $6,000 to $8,000 a year instead. The difference over 5 years is $70,000 to $95,000. That's an extra year of retirement spending. That's the down payment on a retirement home. That's meaningful. And all they did was choose which pile to pull from first. Now here's the really dark part that nobody talks about. The reason so many people end up in the qualified, rich, cash-poor situation isn't because they're bad at saving. They're incredible savers. It's because the incentive structure of employer-sponsored retirement plans is designed to funnel every dollar you save into those pre-tax accounts. Your company offers a 401k match. That's free money, but only if you contribute to the 401k. There's no employer match on your brokerage account. The tax deduction feels amazing when you're in your peak earning years and your marginal tax rate is high. You're saving 22 or 24 or even 32 cents on the dollar by taking that deduction. It feels like winning. Nobody tells you that you're building a tax bomb that's going to explode in retirement when you need the money and you have no choice but to take it all as income. The system is designed to make the 401k look like the optimal choice every single year, even when it's not optimal for your 40-year financial picture. Let me tell you about the most frustrating client call I ever had. Guy calls me, he's 62, he wants to retire immediately, he's burned out, he hates his job. He's got $1.8 million saved, I'm running the numbers, and everything works. He can retire, he'll be fine. Then we get to healthcare. He's got $1.7 million in his 401k and IRA. He's got $80,000 in a brokerage account and some cash. I show him his healthcare costs are going to be in the $20,000 to $22,000 a year range until 65. He loses his mind. He says he can't afford that. I'm looking at the spreadsheet. He's a millionaire. He can absolutely afford that. But the psychology of writing a $20,000 check to an insurance company every year is so painful that he's seriously considering working 3 more years. I asked him, if you work 3 more years, what does that get you? He says, well, then I don't have to pay for healthcare. I said, you're going to work 156 more weeks, which is about 6,240 hours, assuming a 40-hour work week, to avoid spending $66,000 on healthcare when you're sitting on $1.8 million. He paused. He hadn't framed it that way. Turns out he makes about $85,000 a year. 3 more years is $255,000 of gross income, about $160,000 after tax. So yeah, mathematically, working makes sense if you're purely optimizing dollars. But what's the point of the money? He'd been saving for 30 years for the exact purpose of not having to work. And now he's going to delay it because of a completely manageable expense that's already baked into his retirement budget. That's not a math problem, that's a psychology problem. I also want to address the elephant in the room about these subsidy changes and what happens if policy keeps shifting. Because it will. The enhanced subsidies expired. They might get extended again. They might not. The income thresholds might change. The structure might change. There's always going to be policy uncertainty around this stuff. So how do you plan for that? You plan for the worst case? Then you get pleasantly surprised if it's better. When I run retirement projections, I don't assume subsidies unless I know the person can engineer their income to qualify under the current rules. I run a scenario where they're paying close to full premium. If the plan still works, great, you're protected. If subsidies stick around or come back, that's extra cushion. You get to spend more or retire earlier or leave more to your kids. But you're not depending on policy staying favorable. The people who get crushed are the ones who built a retirement plan that only works if they get subsidies, and then the subsidies disappear. That's not planning. That's hoping. Here's my take on this entire situation. Healthcare is not the reason to avoid early retirement. It's an excuse. It's a convenient, socially acceptable reason to tell yourself and your spouse and your friends why you're not pulling the trigger on something that's actually scary for entirely different reasons. Retiring early is terrifying. You're walking away from structure and identity and a paycheck. Healthcare costs are concrete. They're a number. There's something you can point to and say, see, this is why I can't. It feels rational. But when you actually run the numbers, most of the time it's manageable, especially if you planned ahead. The real barrier isn't healthcare. It's the emotional and psychological transition of retiring before you're supposed to, according to societal norms. Let me give you the 3 actual takeaways that matter. First, if you're more than 5 years from retirement and you've been maxing your 401k, stop. Not completely. Take the employer match because that's a 100% return. But everything beyond the match, start flowing into a taxable brokerage account. You're building flexibility. You're giving yourself the ability to control your income picture in retirement. Yes, you're giving up the upfront tax deduction, you're paying tax on that money now, but you're buying optionality later, and optionality is worth more than you think. Second, if you're already close to retirement and everything's in retirement accounts, run the numbers on the worst case healthcare scenario. Don't use averages. Use the full premium for your area and your age and assume 0 subsidies. If your plan still works, you're fine. Stop worrying. If it doesn't work, then you have a decision to make. Work a little longer to build up taxable savings. Take on slightly more portfolio risk to generate higher returns, or accept that you're going to spend down assets faster in the early years and you'll have less left at the end. Those are the trade-offs. Pick one, but make it a conscious choice, not a default. Third, understand that the ACA subsidy structure rewards people who know how to play the game. It's not about your net worth. It's about your income. If you have $2 million in a brokerage account and you're pulling $70,000 a year to live on, with only $18,000 of that showing up as taxable income, congratulations. You're low income, according to the healthcare marketplace. You qualify for subsidies. Is that the intent of the policy? Probably not, but it's how the rules are written. And the rules don't care about fairness or intent. They care about the number on line 11 of your 1040. Learn the rules, use them. Lazy investing built more fortune than crypto memes, and strategic healthcare planning saves more money than chasing yields. The point is this: you spent decades building wealth, specifically so you could retire on your terms. Don't let a manageable and plannable expense that you can literally engineer around become the reason you work years longer than you need to. Figure out which pile your money's in. Build the right pile if you haven't already. Run the real numbers, not the averages. Then decide. Healthcare is a line item. It's not a life sentence.